So, in the final chapter of the fin module, and one that covers this type of accounting for investments over here in the equity investments. So in the previous videos, I've already gone over what each of the differences between the three types of accounting for investments are. So now we're going to be talking about equity method, where a company has a significant level of influence, but does not have control over the company. So we talked about some of the differences between equity method and consolidation method already. The key one being that equity method reports their investment as a single line, whereas consolidation reports everything as if they were the entity at 100%, and then adjusts out the non-controlling interest. So in terms of adjustments, another difference is that equity accounting adjustments are recorded against investment in associate or investment in joint venture, which is an account in the balance sheet or statement of financial position. And the account that they're listed against in the P&L is the share of associates' profit after tax. So it's literally just a one-liner, takes the net profit at the percentage of ownership. Whereas with the consolidation method, it's 100% of the P&L, and then you adjust out the NCI. Okay, and then the proportion of investees' balance is recorded. So the investor share of the associate or joint ventures post-acquisition earnings are recognized, and generally the investor share of inter-entity transactions are eliminated. Whereas in the consolidation method, 100% of subsidiaries' balances. So again, it's just a matter of this is percentage of ownership, this is 100% ownership. Okay, so here's some just general dot points. Some equity method is generally based on the investor's ownership interest, so that percentage in their JV. We use the equity method to present the post-acquisition movements in retained earnings and reserves of the acquired entity. So again, not at 100%, it's at the percentage movement in retained earnings. Okay, so there's a bit of a three-step process here. Step one is ensure consistent accounting policies and reporting dates. So if an investor's financial statements should be prepared using uniform accounting policies for like transactions. If an associate or JV uses accounting policies other than those adopted by the investor, appropriate adjustments must be made using that entity's financial statements. So you can't just take it as is, you have to align it with your own accounting policies. If the reporting date of the associate is different to that of an investor, adjustment for significant transactions or events to align the fin stats with those of the investors should be made. For example, if you get if you made an investment in a company which has a December year-end profit, you actually need to adjust half of that, take half of the previous year to align it with the 30 June year-end. However, if this is impractical, a maximum difference of 3 months between the end of reporting dates is permissible. So it's okay if it's only 3 months. For example, a September year-end to a June year-end is okay. So where do we apply the equity method? Okay, so application of the equity method. So accounts prepared by the investor. The investor prepares the consolidated financial statements as it is a parent entity in a group. The investor does not prepare financial estimates as it is not a parent entity in the group. Where is the equity method applied? In the consolidated financial statements, in the investor's own separate financial statements. Nature of the equity journal entries. Equity journal entries are notional, i.e. recorded in the consolidated work paper, and equity journal entries are permanent, i.e. recorded in the general ledger. Does IAS 27 apply? If the parent entity itself holds the investment, then it applies in IAS 27 in separate financial statements. In the parent's separate financial statements, the investment can be accounted for at cost in accordance with IFRS 9. Whereas under this method, no. Okay, so prepare all necessary equity accounting journals as required by IAS 28. So similar to a business combination, an investor is required to determine the amount of any goodwill or negative goodwill at acquisition date. So if there is negative goodwill, an equity accounting entry must be recorded to recognize the amount as income. So how do we recognize goodwill where we haven't actually got the value of all the assets as we do in business combination? Well, you just purely take the investment cost, how much you paid, less the investor's share of the net fair value of the investees' identifiable. So just take their balance sheet, take all their assets and liabilities as close as you can, less, and then the difference between that and the investment cost is either goodwill or negative goodwill. Okay, and then the equity accounting journal entry. So it involves the subsequent measurement of the carrying amount of the investment at an amount that includes the post-acquisition movement of the associates or JV. Okay. The investor's share of post-acquisition movements in the retained earnings is recorded by raising equity accounting journal entries through the 4 sub-steps. So the first sub-step is record the investor's share of current year profit losses of the associate or JV. So you disclose that as a separate line item in the special profit and loss and other comprehensive income. The second step is to record the investor's share of post-acquisition movement in reserves and opening balance retained earnings in the associate or JV. Step 3 is to eliminate the effect of current year dividends paid declared by the associate JV. And then final one, record adjustments to the share of associates JV profits losses as required. So you'll go through each of these steps in the accounting. Oops, sorry, just lost CA. Let me just bring it up here. So let's go through it quickly. Equity accounting. So we'll go through each of those steps in the accounting templates over here. So if you bring this into the exam, it'll tell you the exact journal entries you need to post for each step. So first of all, eliminate dividend from investee, movements in revaluation reserve, record the investor's share of current year profit and loss. 4, eliminate unrealized profit and loss on the company's transactions. 5, calculate the equity carrying amount. 6, the tax effect. And that's it. Okay, so let's go back to the theory again. With the technical journals, you can just follow the template in the exam. You should be fine if you take that approach. Complexities with the equity accounting. So if an entity continues to apply the equity method, even if its ownership interest is reduced, the entity must classify to profit and loss the proportion of the gain that had previously been recognized in OCA relating to the reduction in ownership interest if that gain/loss would be required to be reclassified to profit and loss on the disposal of the related assets liabilities. Consolidating a foreign asset. So when an entity holds an interest in a foreign associate/JV, the normal equity accounting procedures outlined apply. Recognizing the tax effect of the equity carrying amount of the investment. So on application of the equity method, there will be a difference between the original cost of the investment and the equity accounted carrying amount. This can result in a temporary tax difference. Okay, so what happens if you want to discontinue the equity accounting? So you can do this when either, 1, the investor no longer significantly influences the investee. So you then adjust it so that you account for the investment at cost, as we talked about before. So the investor must measure at fair value any investment retained in the former associate JV. The investment is then accounted for in accordance with IFRS 9. Any difference between the fair value of the remaining investment, along with proceeds from disposing it, must go to profit and loss, and then it can be held at cost. Okay, the second situation where you can discontinue the equity account method of accounting is when the investor's share of the investee's losses reduces the carrying amount of investment to below 0. In this case, it must be continued as the investment is recorded as 0. A liability for additional losses is recorded by the investor only in limited situations. When the investor resumes the application of equity accounting, it must not recognize its share of profits. Until these offsets its share of losses, it's not recognized. Okay, so the principles of joint control or significant influence must be satisfied. So we mentioned that as one of the criteria is that there is significant level of influence. So just as a financial metric, generally 20% to 50% of shares is a good idea, but again, it's not about, similar to business combinations, it's not about the number of shares they hold, it's about whether you can prove that they have significant influence, which is a qualitative characteristic, not a quantitative like number of shares held. So when does joint control exist? There's two types of joint arrangements: joint operations, and joint ventures. So joint venture is when the parties have joint control of an arrangement and have rights to the net assets of the arrangement. Whereas joint control is contractual agreed sharing of an arrangement, where it exists only when decisions about relevant activities require the unanimous consent of the parties. So this is to do with output and assets and funding, and this is sharing of control, particularly via contract or agreement about stating that all decisions must be unanimous. Okay. And here's some disclosures which you should include. Generally, you won't get a disclosure question in an exam, but if you do, I just refer back to the notes rather than knowing it off the top of your head, because they are quite specific and not something you need to know off the top of your head. Okay, so that's the end of the CA module. Next step, in order to prep for exams, I will go through some past exams and just walk through them, because practical learning is the best type of learning. Thanks for your help.